short disclaimer. You should always refer to financial experts when you're projecting revenue expenses for your businesses or your organization. Although this is just a quick slide to cover that aspect. And now finally, to introduce Amber for today, she is going to give us the talk on the first of our topics today, which we can also put in the chat as we start discussing as we go through Amber's presentation.
All right, thank you so much. So I am just going to share my screen with you guys. How is everyone feeling? We're on the topic of taxes. Does that make anyone feel a little uneased? If you feel uneased, put it in the chat box. If you feel comfortable and eager, put that in there. If you're like, please let me understand what's going to be talking about, or how are you guys feeling this morning? Comfortable and eager. I love that. Who else? Do we have someone that's mentally exhausting? Yes. So you must have been dealing with 1099s. All right. Nervous about taxes. All understandable. That's great. Thank you for sharing that with me. Again, if you guys have questions, put them in the chat box, and then at the end, we'll go back and see what questions we could answer. So we're just going to dive in. And so today's topic is going to be about structures and how they matter. We're going to talk about business expenses and some taxes. So I'm Amber Hillis-Parker, and I'm the owner of Hillis-Parker and Associates. All right, so before we get into the meat and potatoes of our presentation, I want to start off with a little story. So long before Hillis-Parker and Associates was established to help small business owners, there was a girl who lived in a small rural town on the Navajo Nation. Her name was Amber. Amber was one of 4 children to Clyde Hillis, who was a Vietnam vet, a Purple Heart recipient, and an entrepreneur. Amber watched her father work day in and day out to build his business on the reservation without much support or outside resources. Clyde was a highly skilled electrician, and he believed it was his privilege and duty to bring his knowledge and much needed skill set back to the reservation to serve his people. In despite of his efforts, Amber's dad had to close his business after several years of hard work. When Amber asked her dad what had happened, he cited one resource he really needed was financial knowledge, and he wished he had a good CPA on his side. On that day, unknown to both of them, a seed was planted. That was Amber's first experience seeing a small business owner struggle and really come to the realization of how powerful financial knowledge is. So, how many of you have heard a similar story to that? So put a 1 in the chat box if you heard something similar to that story, where you have this highly skilled individual. They start their business, but it's a struggle to get growth or to keep it going long term. So I see several 1s. Yeah, this is a very common story, and one that I've been personally impacted by. So that little girl was me 31 years ago. So let me properly introduce myself. Yat Asha Amber Hillis-Parker Yanasha Kiani Nishle. Hanagat Ne Bushish China Kaidana Dasha Tutsutni Dashanella. Hello everyone. I'm so happy to be sharing this time with you. I'm of the Towering House people, born for the one who walks around. I was born and raised on the Navajo Nation. I'm a certified public accountant. I have over a decade experience in the accounting field, managing financial statements from 150,000 to 132,000. I'm a wife, I'm a girl mom, and the story of my dad is really where my passion comes from. And I know as my purpose is to be able to use my skills and services to help other entrepreneurs. And that story is one of the reasons why we recreated Hillis-Parker and Associates. So we are an Indigenous woman-owned accounting firm. We provide bookkeeping, accounting, and advisory services to Indigenous entrepreneurs and nonprofits. We're based here in New Mexico, but we service people remotely across the US. And we specialize in mapping your unique path to money freedom, wealth creation, and financial knowledge. We are in the stages of launching our sister company, which is Her CPA, which really focuses on supporting women entrepreneurs. So with that story, I want to get into a disclaimer, something similar to what Ms. Black had shown. So this material is for informational purposes only. Please, any information that you get from this, please consult with your own tax, legal, or accounting services to make sure that you're handling the transactions correctly. So again, I'm going to ask you one more question just to make sure everyone's awake. All right, so in the chat box, if you can tell me where you are with your business. Are you in the ideation phase where you're gathering information? Put a 1. Are you in the startup phase? You've been in business for 1 to 2 years, or are you in the growth established stage, like 2+ years? So we have some startups. We have several startups. We have growth people. We have ideation. Awesome. We have some people that are in between 2 and 3. So good job. All right. So for those people, can you also tell me if you sell a product, put product in there. If you sell a service, type in service. If you do both, type in both. Service, service, both, service, service. All right. So we have a mixture of people. So thank you for that information. So in my profession, being a CPA, I meet different business owners. I meet writers, I meet VAs, I meet construction owners, lawyers, bankers, counselors, right? The list goes on. And I meet people who are in different stages of their business. And a lot of time, they're the best in their trade. They are the best lawyer. They are the best IT person, the best financial services person. They are the best at what they do. And then they roll into becoming an entrepreneur. And once they put on the role of entrepreneur, they also become not only the CEO, they become the IT person, right? So how many times have you had to deal with a computer and now you don't have an IT person to call, now you're working on your computer to get that going? Or maybe you have staff and now you have to be HR. Or you're also the CFO / bookkeeper, right? So as an entrepreneur, you're wearing several different hats. But what I know is a big determining factor on how fast a company will grow highly depends on the owner's financial knowledge, right? That's like the basis of what I see when I see business owners being successful is how well and how comfortable they are with financial knowledge, whether that's they know it themselves or they partnered with someone, bring someone on board as a bookkeeper, CPA to help with that knowledge. So in today's discussion, we have a range of different people, whether they're starting their business or established. So today's discussion, we really want to start laying that foundation so that you're able to understand what affects you and how it would. So with the information that I'm going to present today, some of this might resonate with you. Some of this might be a little bit overwhelming. And I want you to really be present with this. If you start to feel like you're checking out, just kind of bring yourself back. This information is recorded, so you can always come back to that. But so some of this, people who are in the startup phase, I want you to hear it. I want it to live inside your head. So when you start getting established, you can remember the conversations that we've had. The people that are in the startup or established phase, I want you to go through and kind of do like a checks and balance and really see where you sit with this information. Do you understand it? Is it a little bit complicated? Are you right on track? So I just want you guys to kind of understand where you are with your business. Well, really, some information might resonate with you more than others. All right, so our roadmap here. So what we're going to talk about are 4 different subjects. First one we're going to talk about is our legal entity type. Then we're going to move into our tax classification. We're going to talk about business expenses and some best practices. Does that sound like a good idea? If it's a good idea, put a 3 in the chat box. You guys eager? Woohoo, I got that. 3, we're ready. All right, awesome. Okay, so let me ask you this question. A lot of questions today, right? Hopefully you're awake. So how many of you put it in the chat box a 1 if you accidentally fell into business? You just was not your intent to start a business and it just kind of happened. Put a 1 in the chat box if that's you. So maybe you're like the best cook, right? What about if you knew the best way to make a breakfast burrito, right? So you bring some breakfast burritos into your coworkers, the way that you slice that Spam and made that tortillas, like it's just the most amazing breakfast burrito. And before you know it, now people are coming to you and wanting to have your breakfast burrito. And you're always sold out before 8 a.m., right? It kind of just happened. You just fell into it, right? So next thing you know, you kind of have a business started. Or say, let's say that you made t-shirts for a friend whose son or daughter was on the basketball team and everyone loved your design. And then all of a sudden, now you're getting orders for t-shirts. Or maybe it was progressive. Maybe your family is you come from silversmiths or artists, and it's a skill set that was passed down to you, and you start making jewelry or sand paintings or arts, and then all of a sudden you're getting orders for this, right? So you might have started your business and kind of just walked into it, fell into it, and now you're here. Or maybe it was more intentional. Maybe you were sleeping at night and you woke up and you had this amazing idea. Or maybe you saw that there was something missing. You wanted to solve a problem. And so you start the process. You have this idea. You make your business card. You make a logo. Now you make a website, right? So it might be more intentional. Or maybe you're like in the process of researching, right? Maybe you're like dipping your toe in and saying, is this really what I want to do? What does this all entail, right? So each one of you, whether it was on purpose or intentional, or you're still in the midst of it, you're going to have to build a foundation for your business. And your foundation is what's going to determine how you're being taxed. So before we even get into taxes and all its glory, let's build a foundation here. So when you start your business, whether it was intentional or not, you are essentially building an entity. So you might be the burrito lady over here and you just start up. You don't file anything. You might get a business license, but you just start. So you might be a sole proprietorship. Or maybe it was more intentional. Maybe you started off as a sole proprietorship and then you move into a legal entity, such as filing with your state as a single member LLC, or doing a multi-member LLC or corporation. These are just more of the common ones that we're going to talk about. So single member LLC, 1 person, multi-member, more than 2, and then a corporation. I'm not sure if Earls is a corporation, but everyone knows Earls, right? Put a 2 if you know what Earls is. And do it too if you know what Thunderbird Supply Company is. Yeah, see, I knew you Gallup people would know. So people will start their business and lay a foundation. And these here are the legal entities that you can form. So I'm not a legal expert, so please, if you have any questions on whether or not a certain entity is right for you, please contact your attorney and they'll be able to dive into that. But in order to lay the foundation, let's go over some items, right? Some of this might be new to you, some of this might be old news, but let's just kind of get into it. So the first one we're going to talk about is the sole proprietorship. It's owned and operated by a single individual. The owner and the business is the same person. So think about this over here, this burrito, right? The sole proprietorship, the business of making the burrito and the person are the same entity. Well, these here are separate, okay? So the pros of a sole proprietorship is that it's easy to start, right? You could simply start making burritos. You can simply start selling t-shirts. There's no formal registration, but it's always good to file for a business license, and your income expenses are reported on Schedule C 1040. Super easy tax return. The cons of this is that because the business and the person are the same people, there is no, you are personally liable for any business debt or legal obligations. Also, obtaining capital is very hard as a sole proprietorship. So a lot of times if you're wanting to grow your business, they will require that you're an LLC, starting point there. Also, a con with a sole proprietorship is usually when the business owner is deceased, so will the company, right? So think about if you're trying to leave a legacy. Sole proprietorship is probably not the best way to go. Next item is a partnership. So partnership is formed by two or more individual entities. There's several types of partnerships, which we'll talk about control and liability. The pros for a partnership is that it's easy to register. You have shared decision and management. As partners of the business, you're able to pull together your capital and you share the financial burden. So any profits and loss will be split between the partners. The cons of a partnership is that this is for a general partnership, each partner is liable for the debt and legal issues. What is also a con could be decision making and management. I see this a lot when individuals jump into a partnership and they really didn't take the time to get to know who they're going into business with. They might have a different management style than they do, or the process that they make decisions is different than all the partners. So there could be situations that come up where you're not able to have fluid as a business operations. So if you're ever going into a partnership, it's a really good idea that you go to a lawyer and get a really good partnership agreement put into place, so that when those instances where there is not an agreement, you have a way of being able to come to a solution. Another entity is a corporation, a C Corp. So a C Corp is extremely complex structure. It's a independent legal entity separate from its owners, shareholders. So think of like Walmart or Target or Bash's or Earl's, if Earl's was a corporation. Some of the pros with this is that shareholders are usually not personally liable for business debt. Whenever the corporation needs to raise capital, they can just sell stocks. Usually when ownership changes within a corporation, the corporation continues. So unlike a sole proprietorship, it still continues. Some cons with that is that it's expensive and complex to form and operate. You're subject to double taxation, both at the entity level, and if you were ever to get any dividends, you would get taxed again. and they're subject to state and federal regulations and oversight. So it's a little bit more of a hefty entity, right? And lastly, the one that you guys are probably all very familiar with is an LLC, a limited liability company, which provides liability protection and to operate is very flexible. So the pros of this is that you have liability protection, right? So if you were to be sued as a person, they wouldn't be able to go after your company's assets or vice versa. Your company is sued, they're not able to come at your personal assets. Typically, members or the owners of the LLC are not personally responsible for business debt and liabilities. So as an LLC, if you're going to be signing any documents about debt, have your lawyer review it to see if personal responsibility is part of that. Also, the advantages of an LLC is how you're taxed. So you can be taxed as a sole proprietorship, a partnership, or corporation. Some cons of this is that as an LLC, any of your profits could be subject to self-employment tax. And then as an LLC, because you want to make sure that both entities are separate, so you and the entity are not one like a sole proprietorship, but you guys are separate. So you would not want to commingle funds. So you don't want to go and on your business debit card, go to McDonald's and swipe your card or pay your rent using your business account, right? And this is for several reasons. One, if you were ever audited, do you really want to give them a bank statement that says Hulu and Disney Plus charges and bashes charges and all these items that are really not related to the business? Okay. All right. So have any of you gone on, have any of you went to your state's website and done formation? So put a 1 if you've done your formation. All right, we have several people that have. Good job. So maybe you've done your formation, but you don't really understand what you are. How many of you are like that? Like you did the paperwork, but you're like, I really don't know if I'm a single member, multi-member, or C Corp. If you don't know, there's several ways that you can find out. One, you can go to your Secretary of State website. So this is New Mexico's and this is Arizona's. And you can go in there and search for your business name that you submitted. And usually it'll come up and tell you, give you information about your entity. Also, when you did your formation of your business, you probably submitted either like articles of incorporation or articles of organization or partnership agreement. So those documents will tell you what type of legal entity you are. And those of you that are still like researching and gathering your information, when you get to this part, it's very important that you save these documents, okay? So save these documents, keep them in a safe place, okay? So we're here talking about legal entities, and today's program is supposed to be about taxes, right? So how many of you guys are like, where's the tax information, right? This is what you came on to get, this beautiful tax information. So why we're talking about legal entities is because it's the foundation. And also we're talking about legal entities because we get into the subject about how your entity is being taxed, okay? So after you do your registration with the Secretary of State, usually you're gonna go onto the IRS website and request for an EIN. And if you don't select anything different, you have a default, okay? So how you're structured will determine how your taxes are. So before we get into that discussion, let's briefly talk about all the different taxes as a business owner that you might encounter in the lifetime of the business, okay? So when it comes to taxes, it depends on several factors, right? And this is this is a common question where people will ask, and usually the question is it depends, right? So items that might trigger certain taxes versus the other is your tax classification, which we're going to talk about. What might trigger a tax is also if you're selling a product or a service, your location, where you do business, the amount of revenue that the business generates, and the amount of profit that the business generates, right? So several of these factors, there could be other ones, there probably are other ones, can determine which of these taxes you might be hit with, right? So some of the taxes might be income tax, such as federal and state, which this is probably the number one tax that you're very aware of, right? We know tax season's coming up. You're seeing the H&R Block commercials. You're seeing the TNR. You're seeing TNR loaded up with people, right, for their tax department there. But another tax, depending on whether or not you have employees or how you pay yourself, might determine self-employment tax, which will determine payroll tax. So some people might get self-employment tax. Some people will have to pay payroll tax, depending on if you're selling a product and service, what location you're in. So in New Mexico taxes every service and product that is sold, which is different from other states, right? So you might encounter sales tax or gross receipts tax. You might have property tax if the business owns a property. You might have excise tax. You might have unemployment tax, capital gains tax. There's several taxes, right? So with our conversation today, what we're going to focus on is this tax classification, how your legal entity defaults to certain tax classification, and how this profit will affect how your profit will affect your income tax here. Okay. Tomorrow and the next day, Delphina is going to shed some light on some other areas such as sales tax, gross receipts tax, which she'll talk about products, location, services, different things like that. Okay. So if you didn't have plans on attending the other presentations, please do so. It's really great information. All right, so let's get right back into it. How are you guys feeling? Does anyone feel like, oh my gosh, like it's hard to breathe? Or are you guys like, okay, just give it to me. Let me know what it's like. Okay, you guys are feeling good. All right, let's just jump in. Okay, this next couple slides going to be a couple, some information, but screenshot this, come back to this later and kind of look at it, analyze it, okay? So we talked about legal structures and how depending on your legal structures determines your default tax classification, okay? So sole proprietorship, the burrito lady goes out and she just does business, right? She's going to be taxed as a sole proprietor, okay? Single member, your automatic default is a disregarded entity. So same as a sole proprietorship. A multi-member LLC, you're going to be taxed as a partnership. A C Corp, you're going to be taxed as a C Corp, right? There's benefits to moving to an S Corp, right? But you have to make an election to become an S Corp. So what you would do is if you know that there's tax advantages going to an S Corp, you can make that election, okay? So the elections can be made. So a single member LLC could be elected to be taxed as an S Corp. So could a multi-member LLC and a corporation. A single member LLC and a multi-member LLC could select to be taxed as a corporation, but that's very far and in between that happens there. So remember, when you start off, your default is here in the yellow. You have to make an election, send in paperwork to the IRS to say, I want to be taxed as an S Corp. Okay. Pretty good information, right? But why does it matter? Why does tax classification matter other than taxes, right? But let's get into some more information. How many of you have ever had the question of how do I pay myself? Put a 2 in the chat box if you've ever come across that too. Like, how do I pay myself? Yeah, I see that a lot. So tax classification will affect how you pay yourself, okay? So when we get here, tax classification will go into what forms will be filed, okay? So if you're a sole proprietorship, you're gonna do a Schedule C on your 1040 with your 1040. S Corp, you're gonna do a Form 1120S. Partnership is a 1065 and a corporation is a 1120, right? Those don't probably mean anything to you, which is fine. But what would be beneficial to you is knowing when those due dates are, right? So we all know that April 15th, that's tax day, right? But for an S Corp, your tax due date actually moves up by a month for a S Corp and a partnership. So you should be giving your information to your tax preparer for them to file before March 15th. A C Corp is due on April 15th, okay? Great information. Thank you, Amber, for sharing that. How do I pay myself, right? Golden question. So depending on your tax classification will determine how you pay yourself. So a sole proprietorship will just take an owner's draw. All right, you probably have heard that before. With an S Corp, once you select an S Corp, now you get into some more high level items. So one of the requirements for an S Corp is to give yourself a reasonable salary. And that actually means running payroll. So that means you're going to be paying payroll taxes as well as filing your 941s, your 940s. You're going to be submitting W-2s, different things like that. And so when you're going through your S Corp, if you decide to do this and you're not consulting with someone, just know that you need to give yourself a reasonable salary and you need to run payroll for yourself and do a W-2. All right. So when we talk about other ways that an S Corp can get paid, an owner, right? You can do a dividend or a distribution. All right. For a partnership, this is one area. Not only would a partnership be, would you need to have really detailed language in your partnership agreement on how, what percentage of profits and loss are split between the partners. Another thing that's going to be in here is a discussion about guaranteed payments. Guaranteed payments are guaranteed payments. So imagine putting together a partnership agreement and what you have is guaranteed payments of $5,000 a month for each partner, but you're not making any money. So guaranteed payments, you have to pay them regardless if you have income or not. So it's one of those areas where you really consulting with someone is going to be beneficial. So you will pay yourself. If you're a partnership, you will pay yourself through guaranteed payments or through distributions. And if you're a corporation, so think of Walmart. So if you work for Walmart, you're an employee, you're going to get a W-2. If you have stock in Walmart, if they do a dividends, then you would get dividend income here. All right. But this is great, Amber, but how does this affect my taxes, right? So these affect your taxes and how your payments come in several different ways. So for a sole proprietorship, right, the purpose of a business is to generate profit, right? That should be the purpose of it. So at the end of the year, when we do tax time, what you're going to be taxed on is the profit of the business. So if you say, if you have your revenue minus your expenses gives you your net income or your profit. One area that can help reduce profit would be business expenses. So when it comes to a sole proprietorship and whether or not payments to a sole proprietor would be tax deductible or not is a true business expense. In this case, it's not. Okay. So anytime that a sole proprietor pays themselves, they can either go to an ATM, they can go in the bank, they can write them a check, themselves a check, they can transfer the money. That has no effect on your net income. So it does not reduce your taxable income. However, for an S Corp, all those wages that you pay yourself as a reasonable wage is tax deductible. Okay. For a partnership, your guaranteed payments are tax deductible. And for a corporation, any W-2 wages would be tax deductible. Okay, so let me show you this in a different light here. So let's look at this. So here's kind of the income statement that we kind of talked about. So your income statement shows your revenue. In this case, our revenue is 10,000 here. We're going to deduct our wages or our business, our guaranteed payments. In this case, our guaranteed payments is 5,000, and then we have office expense of 1,500. Okay, so up here, any payments that a sole proprietorship gives to the owner would be shown on your balance sheet. It has no effect on your income. Okay. And so here we have revenue of 10,000. We can't deduct wages or any owner's draws here, so that's 0. And the only thing that we would be able to deduct in this situation is 1,500. Okay, so the net income for this sole proprietor is 8,500. Okay, not bad, right? Here's when we get into the benefits of these other tax classifications, okay? Any of these business expenses are going to hit your income statement, okay? All of these, everything right of this is going to hit your income statement. So let's go down here and look at our revenue. So our revenue is 10,000. Our wages or guaranteed payments is 5,000, and then our office expense is 1,500, which makes our net income 3,500, right? Are you guys seeing the difference here between how income statement might look for a sole proprietorship versus someone who elected to be an S Corp or a partnership or a corporation? Are you guys seeing that? Put a 3 if you're seeing that and it makes sense, or you're kind of seeing how the information flows. All right, so this information can be overwhelming, right? I'm sure some of you guys are like, whoa, she was like talking about all these words out there and talking about statements, right? This can be a little bit overwhelming at sometimes. And this is why working with an accounting professional is so valuable, because they will help you navigate this if they have the ability to do so. So so if you're starting off as a sole proprietorship and you're trying to take that wage on your income statement, they might say, hey, that's not the proper way to account for that. It actually goes on your balance sheet and not your income statement, right? So if you're working with a good accounting professional, they might say, hey, you're an S Corp, you should start doing running your payroll, right? So partnering with a good accounting professional as well as a tax professional will help you get to the correct net income for your business. All right. So it does, as we see, tax classification determines how you get paid. How you get paid will determine if it's tax deductible or not. All right. Did I lose you guys, or I still got you? Put a 4 if I still have you with me. Awesome. Thank you, Jackie. Thank you, Josh. All right. And remember, if this was a little bit overwhelming, go back to the YouTube video, rewatch it, and just kind of get yourself familiar with that. All right. So while we're on the subject of expenses, right? We talked about wages and office expenses. Let's talk about some other expenses. Okay. So what is a business expense? So to be deductible, a business expense must be both ordinary and necessary. What does that mean? Can anyone give me a shot of what ordinary and necessary means for your business? Anyone? Gas could be ordinary, necessary. It could be, but we'll talk about gas a little bit later. Office supplies, right? All right. So this is where taxes can be a little misleading, right? So what I come into counter with is we might bring on a client and they are deducting something that wouldn't be ordinary and necessary. And they say, well, my friend runs a business and they have this cost. And so I think I should do, right? So just because someone does it for their business doesn't mean it applies to yours, okay? So I'm going to give you an example. So a business expense being ordinary means that it's common and acceptable in your industry, all right? A necessary expense is one that's helpful and appropriate, all right? So let's do this example here. I own Hillis-Parker Associates. We're an accounting firm, right? Is a purchase of a tractor ordinary and necessary for me? Yes or no? Put it in the chat box. No. But Josh, I just think so much better when I sit on a tractor. No, Jackie, I'm getting all these no's. And I would say, that's correct, right? For my profession, owning a tractor is not common in my practice, in my industry, and it's not really acceptable. It's not helpful, right? And it's not really appropriate. But would a calculator be ordinary and necessary for my business as an accounting firm? Yes or no? Yes, yes, yes. All right, thank you. So when it comes to business expenses, your friends might have a business that's exactly like yours. Some might not. So when it comes to whether asking a question, whether a expense can be deducted, always go back to this. Is it ordinary and necessary? Is it common and acceptable? Is it helpful and appropriate, right? That's always kind of like your little guiding light there. Kind of ask those questions. So, and business expenses are the first defense that you have when it comes to paying taxes, okay? So you don't want to get in a situation where you claim all these business expenses, you get audited, and now you can't write off that tractor in your business, right? So business expenses are the first line of your defense. Make sure that they're ordinary and necessary. Some of the common business expenses is some of you might have startup costs. So you put your own money into the business. You want to classify that on your financial statements. So when you start working with your bookkeeper, accountant, make sure that you are saving all of those startup costs. So say that you had to buy a laptop to start your business. Say you had to file for your Secretary of State. That's a cost that you want in there. Advertising. So you want to do Facebook ads about your business. That's advertising. Consulting fees. Say that you, after 3 days of learning about taxes and compliance, you need help, or you say, hey, I want to be proactive, then, either engaging in services with myself or Delphina, that would be consulting fees. You might have dues and subscriptions, office supplies, depending on whether you can be paid, how you should be paid by the business, or whether you have employees, you might have wages or expenses. And you might have inventory material, licenses, continuing education courses. You might have a cell phone. You might have a personal cell phone that you use for business. You might have business meals. One thing that I want to address with business meals is that they really should be tied to a business purpose, and that they should be not extravagant. So I see this a lot with business owners. They're just going to go swipe their card and claim it as a business meal. It really should be attached to a business purpose. So are you meeting a client? Are you traveling for business? Is it a reasonable cost, right? You're not going to go you're not going to go have this extravagant meal of $5,000, right? If that's not what the industry that you're in, right? So we can really kind of look at cost and what's reasonable or not. Another common business expense could be your home office deduction, which would include either writing off a portion of your rent, if you have a mortgage, your mortgage interest, your utilities or your internet, if you have homeowners or renters insurance or property tax, as well as your vehicles. So you can write off a portion of your car expense there. So one of the areas with these common expenses, right? So depending on where you are with your business, partnering with the bookkeeper, accountant is really going to help you navigate this field and making sure that you're capturing all the expenses that you could possibly put under the business in a legal matter, right? That's the benefits of working with someone who's in and out in this profession here. So commonly that I see people having a lot of questions is regarding like their cell phone, their car, and their home, right? So do you guys want to talk about those a little bit? Put a 1 if you want to talk about it. If I don't get a 1, I'm just going to skip like all the slides. Just kidding.
What was that again? What do we want to talk about? The home?
Yes, home, phone, cars.
Yes. Because like a home office, what if you had a home office versus a place you're renting, I guess?
Yes, we'll talk about that here. So awesome. All right, so let's dive into phone expense. So how many of you use your own personal cell phone for both business and personal, right? You probably don't have that expense under the business, and that's fine. That's that's very fine. But what we want to do is be able to capture those expenses and put them on your income statement so it lowers your taxable income, right? This whole discussion is about how do we lower your taxable income in the most ethical way, right? Reasonable way. So phone expense. So here's a little dashboard here. So I've seen this done several different ways. This is just a combination way. So say that you have say that you and your spouse work together and your spouse came on half of the year, right? So what we're going to do is we're going to add up the total phone bills. So all your phone bills for the year. So say that each phone bill for my phone is $100. I have a total cost of $1,200 for the year, okay? And what I'm doing is I'm going to estimate how much of my phone is used for business and how much is used for personal. So of this 1,200, I can take 75% of usage of my cell phone. And same thing with your spouse, or say you brought in an employee, different things like that. So you're basically estimating what your cell phone usage is here. So if you don't use your cell phone for business, then, you know, I would say be ethical about it and don't write it off. But if you use it for your business, then go ahead and take that. So what you're going to do is you can break out your phone bill. If you have multiple people on your phone bill, just break out what your cost is for each month, decide what your percentage is, and then you would take that deduction. Okay. So this is one area that you don't want to leave on the table. So if you paid $1,700 for your phone bill, you can take this $1,275 here. So for coming up with your business phone use, this is really like an estimate that you really need to kind of focus on for yourself. Someone who's maybe doing like a side hustle, that might be lower. For me, my business phone line gets connected to my personal. I have my my emails on it. I take calls. I do everything with my phone, right? So my percentage might be higher. So just might want to track it. If you guys are time tracking, you know, what activities might mean that you're using your phone. All right. So this is something that you can do. You can calculate this now. So when you go and work with your tax professional, they have this information and they can start adding that to your taxes as a reduction to your taxable income. So the next thing that we're going to talk about is the home office deduction here. So the IRS says that you can do this two ways. You can do this in a simplified method where you just multiply it by, I forget, I think it's like $5, right? But it's super simple. You just take the square footage of your house times the rate that they give you, right? It's very simple, but majority of the time, you're not going to reap the biggest benefit if doing a simplified method. So what you want to do is, and this might be one of those, you know, Saturday afternoon projects. You can do this by going in and say that you pay rent. You're going to go and add up all the rent that you paid for your home. So if you work from your home, this would be part of this here. So you're going to take all your rent that you paid for the year and input it in a cell. If you have insurance, so if you're renting, you would put your insurance here. If you have a mortgage, you would look at your statement and say, what interest did I pay for this tax year? So all of 2023, how much mortgage interest did I pay? If you have any other taxes, you have an HOA, you're going to put this in here. If you had to do some sort of maintenance related to your home office, you're going to put that. If you have a home telephone, which I don't see this a lot, but if you do, you can take a portion of that. If there's any repairs, if you have utilities, so all of your sewer, gas, electricity, trash, any of those utilities, you're going to add them up and you're going to list them here. Okay. If you have internet, everyone has internet. If you're working from home, you're going to add up those costs as well. And what you're going to do is you're going to come down to this total cost here based on your square footage of your house. So in this situation, the size of the house is 1,800 square feet. The home office is 500 square feet. So we're going to take almost 30% of this, almost 15,000 as a reduction in income. Okay. So now I have this expense here. And so this is the benefit of working from home, okay, is that you want to go through here and do this. So I know this is time consuming, make it, going forward, make it like a ritual while you're going through and updating your budget, your personal budget is going through and doing this information here. If you have this and you're doing this throughout the year, it's easier to capture all the expenses than to come say in January and you're like, I know I did this, or I know this happened. And now you're going through bank statements. Now you're trying to figure out what has happened. So if you're doing this on a monthly basis, this would be great. So mileage is another way that you can get a reduction. And this is where I see that people really have an opportunity where they can maximize their tax deduction, and they just are not being proactive or don't know all the intricacies of that. So if you are using your personal vehicle for business, you want to track those miles, right? So how many of you guys are using your personal vehicle for business? So put a 2 if you are. Yeah, so a lot of people are, right? And we know gas is expensive. And even if you're using it sometimes, you still want to track this. This is a benefit that you're getting here. So ideally, for every business owner, you really should be like taking a picture of your odometer of your vehicle when you start the year. So if we were talking 31 days ago, I would say go out there and take a picture of your odometer, right? Or start tracking what your starting odometer is. And what you want to do is you want to have this log. So down here is this log here where I'm saying what trip it is, right? So I'm giving a date, I'm saying what my starting point is, my ending, what mileage, if it was business or personal, right? So there's two different ways that you can do mileage. So one is a simplified method, right? Which you guys are probably all very familiar with, where you go and you add up all your business trips and you times it by the IRS reimbursement rate, which for 2023 was like 0.655, right? 24 is 0.67, right? So when you're in this process here, you're tracking your mileage. You might not reap all of the benefits from this tax deduction. So, of course, the simplified method is simple. It's easy, right? You just track this and you give this information to your tax preparer. They add it to your financial statements or deduct it on your tax return. The other method is to track all costs that are associated with a vehicle. So say that you have a truck and it's your only vehicle and you use it both for personal and business, okay? Not only are you going to track every time that you use that vehicle, whether it's personal or business, you're also going to track any cost that it takes to operate that vehicle. So say you have an older vehicle and then all of a sudden you have to get an oil change. Well, everyone has to get an oil change, right? And like, look at that amount, $12 for an oil change. I would love to go there. Or say you have repairs, $75, but we know those are not realistic. Say that you need new tires, right? Working on the reservation, you're probably driving from one end to the other. So tires you're going to go through. You're probably going to need a replacement of your window, right? With all the debris coming up and busting your window. So what you're going to do is you're going to track all of those costs, any gas, any time that you go and you get an oil change, you got to get your, any replacements, any repairs, right? When it comes to year end, you're going to have this whole list of all your expenses for your vehicle. And you're also going to have a list of every time that you use your vehicle for business or personal. And when it comes to that time, what you're going to do is look at what percentage of the vehicle you use for business and personal, right? So say that you go through and there's more of a tax advantage to going towards the actual method where you're actually adding up all the cost of it and say that your total cost is $5,000 and you use your vehicle, you use it 90%, then you would be able to write off 90% of that 5,000. All right. If you were just tracking mileage, you're just going to get reimbursed that mileage amount. Okay, so it would be really beneficial if you're using your vehicle a lot and if you have a vehicle that is older, that you're going through and you're tracking all of your cost here because it might actually play out in your advantage. Okay, so just keep this in mind. Tax is doing your tax returns are just around the corner. If you don't have this information, then start it now. If you know the times that you went and saw clients and you can redo a mileage tracker, do that. But just be reasonable about that, be able to support those expenses if ever audited, okay? So the next thing I want to talk about is being proactive, right? So we talked about how these legal entities dictate your tax classification and how you're paid. And what we really want to get down to is this net income, right? This is why working with a accounting professional is going to ensure that you're paying the least amount of taxes, right? We're going to make sure that we're ensuring that all business expenses have been captured. Also, working with a tax professional is going to give you oversight on, hey, it looks like you're going to be paying some big taxes coming up. What tax strategies do we have in place? Maybe when you first started out, you didn't elect to be an S Corp. A tax professional can do the paperwork that puts you in a situation where you submit it to the IRS and you're able to be now taxed as a S Corp, right? So working with a tax professional or an accountant helps you reduce your taxes, right? Also, working with an accountant provides you financial statements. If there is any advice that I can give you is to work with an accounting professional that can help you produce financial statements. Your financial statements should be given to you on a monthly basis. If you want to partner with someone who's really going to sit with you and go over your financial statements with you to give you a better understanding of it. When you are working with an accounting professional, they're going to reconcile your books. They're just going to make sure all the information that needs to be captured are recorded. So a lot of times I will work with individuals who they could have not afforded the services early on in starting their business, which is, we always want to be a blessing and not a burden. But later on, they come to us. And so now what we're trying to do is do a catch up or a cleanup where we're going back and we're making sure that all the books have been reconciled and all of the costs have been on the books. So a lot of those startup costs, they're not going to be on the books. So a lot of times we come into situations just like this where certain expenses were not captured, and it does make an impact in what their taxable income is. So if you can afford it, please talk to someone about getting some help with that there. So in addition to being proactive of hiring the help that you need, we talked about working with a tax professional. It's so important that you partner with the right person. Make sure that you're keeping track of your deductible expenses, right? We went through and said, hey, what's deductible, what's not, right? We know that we want to make sure that expenses are ordinary and necessary. Those are the first line there. Also, if anyone can set aside 20 to 35% of the revenue for income tax, you really alleviate a lot of that stress that I see with business owners. So this means every time that you get paid, say someone pays you $100, you're taking anywhere from $20 to $35 and putting it into a separate bank account. This bank account should not be easily accessible. So make sure, like if you're banking with Wells Fargo, make sure you go put it with Bank of America, something that's going to make it harder for you to access that money. And then when it comes tax time, you have that information, you have that money there, and it's not burden. And I think that's the situation that I see a lot of individuals when they come to us is this tax burden, the fear of not knowing whether they're going to owe or not, right? And we're trying to work with them and saying, okay, well, what expenses can we take in order to lower that? And it really is hard when it comes to a situation where people aren't saving for their taxes or didn't know that certain taxes applied to them. They weren't paying their New Mexico GRT, and now they're having to report this and remit it. So there's certain situations where you really want to make sure that you have the right people on your team. So tax planning does not mean you're getting your information from social media. I'm gonna let that sit in, okay? It's great information and it's a good thing to start the wheels turning. But just because someone says, hey, you're going to save 15% on self-employment tax if you go to an S Corp, do this now and call me, just be able to talk to someone about this and understand how that one decision affects everything else, okay? We went into and we talked about wages and how that affects you. So go to a professional for your tax planning. Information from social media is great because it puts an awareness out there, but dig into it. One thing that I see too is when individuals are usually not working with an accountant when it comes to year end, all of a sudden they think they're going to owe, or they know they're going to owe. And instead of being in a situation where they're here, where they know that they're going to pay $8,500 and they didn't save, they're going to have to pay taxes on this $8,500 and they didn't save for taxes, what they start doing is they start buying, right? And they're buying things that are not going to generate revenue. So I've seen it several times where people do this and all of a sudden they don't have enough money for payroll the next month. So you don't want to put yourself in a situation. So all of this is being proactive, working with someone that's going to support you on the accounting side and the tax side, being proactive and putting aside money so that you're not struggling and feeling that, you know, that eagerness when people are starting to talk about taxes. This is so powerful, and all it takes is discipline. So with tax season right around the corner, here is a list of things that you guys can do. So have your books reconciled. If that does not mean, if that kind of went over your head, or if you're like, what does reconciled mean? What does books mean? Reach out to me or Delphina. We can help you with this here. So make sure your books are fully reconciled so that you reap the biggest, you can take all the tax deductions, everything's in order, you know where you stand, and then going forward, you have a better foundation. We went over like a mileage log. If there's any way that you don't have that right now, but you can recreate it, do that. That's going to help save on your taxes. Start working on your home office expenses. Start going through and looking at your mortgage statements and saying, what did I pay for interest in 2023? Start pulling your Comcast bills and saying, what portion of this is internet and what portion of this is TV? You can't write off TV. Going through your phone logs, your phone bills, and saying, what are my expenses? What do I estimate my percentages of use as business? These are all things that you can do now versus going to a tax preparer and saying, here's my box of receipts. I did drive my vehicle, but I don't have anything logged. Oh, I do work from home. I do have a home office, but I don't have any information, right? The more that you're prepared, the better it's going to be. Also, dig out like your EIN or your state ID number and have that available to give to your tax preparer. So as we wrap up here, some of the best practices that we have here is your legal entity is huge, right? It's more than just having an LLC. It's more than just having a multi-member LLC or a corporation. We talked about how this legal entity determines your tax classification, right? And we went through the whole bit of that determines how you're paid, that determines when your tax return is due. It determines if you want to elect to be something different, right? So knowing your legal entity is the starting point, saving those documents. After you do your registering with your state, go onto the IRS website, get your EIN, keep that document in place. You're going to need that when you go and request for a bank account. You'll also need your formation information to do a bank account. Save your receipts. And when I say save your receipts, this doesn't mean in a shoebox. Receipts do fade. They do fade, and it happens more often than you know. We use a system called HubDoc. It's less than $20 a month. You can scan a picture, you can forward an email, and it lives in there. You can also use QuickBooks. QuickBooks has a feature where you can put that information in there as well. Use an accounting system. When you're starting out, it might not make sense to have a bill of $30 each month, but that's doable when you have transactions less than 10 transactions, right? That's doable to track it on Excel. When you start getting into those transactions where they're just coming, that's when you really want to integrate into an accounting system. Work with an accounting professional, tax professional. They're going to be your best friends. Make sure your expenses are ordinary and necessary, right? Go back to that thought process of Amber owns an accounting firm. Should she buy a tractor? All right. And then seek to understand your financial statements. Okay. So I say that to say, when I talk about financial statements, really take ownership, right? So we talked about my dad and his struggles. And we know, and what I know and what I've seen is that, you know, entrepreneurship is like the best journey you'll ever go on. It is the best gift that you can give to yourself, but you have to be robust in your financial management practices. A lot of these items that we talked about today might be new for you. It might be a refresher, but really aim to understand where you sit financially with your business, with your taxes, and start using these items that we talked about today to start building that foundation so that you have a sustainable and thriving business. Each one of you have the ability to leave a great legacy, and I'm excited to see what you all come up with. So I think we have some time for some questions. Here's how you get a hold of me. So let's get into it. So what did you guys think? Was it overwhelming? Was it good? Do you need to take a breath? You guys feeling confident? Give me a 1 if you're feeling pretty good. So our tribal taxes different for each tribe? Yes. So I believe tomorrow is going to be talking about some Navajo Nation sales tax. So taxes are different depending on where you live. So federal income tax, so at the federal level, are treated different than at the state level. And depending on if you're native and you live and you work on a reservation, determines some tax situations here. All right. Well, I thank you guys for coming. I know it's a lot of information. Feel free to reach out if there's anything specifically you want to talk about. And let's see, I'm going back through and seeing if you have any questions. If not, I'll give you guys back 5 minutes of your day.
So this is pretty common for people who they filed their LLC, but they haven't fully that's not their only source of income and they still have a full-time job. So if they take a break from it for a whole year and are working primarily full-time job that they're getting income tax from, and they had 0 sales that whole entire year, do they still need to file their taxes for their LLC that year?
It depends on what type of tax structure it is. So for partnerships and corporations, you must file regardless if there's any income. All right. Well, thank you, everyone.
It looks like Terry had a question as well. He says, what about self-employment tax? I don't really understand what that is. How does it change from being a sole versus single-membered LLC?
Yeah, good question. So let's go back over to this guy here. So when it comes to self-employment tax, when it comes to self-employment tax, what we really look at is this net income here. So in some situations, this net income is pulled onto your personal return. So in situations here, like a sole proprietorship or a disregarded entity, that is any of the income that you have, your entity the business is not going to pay taxes on this income. But what happens is when you include that on your 1040, that's when self-employment tax is calculated. So as a W-2 employee, every paycheck, you get your little check stub, right? And on your check stub, it says how much is taken out for payroll, Medicare, Social Security, those taxes. That is self-employment tax. However, when you are an employee, you only pay half of those taxes. Your employer pays the other half. When you own the business, you get taxed both for the employer and the employee side. So how that's done is on in your tax return, that calculation is done. With an S Corp, that is a benefit that you save taxes on. So for an S Corp, if this was your situation here, this $3,500 wouldn't be taxed as for self-employment because you're already getting taxed here at that $5,000. So when that W-2 goes out, so when your check stub goes out, you're never getting your full wages, right? So if your paycheck is $5,000 a month, you're never getting $5,000 in your bank account. A portion of that goes away. A portion of that is to pay self-employment tax, pay your portion of self-employment tax.
All right, thank you, Amber. We do have another question from Ed. He's asking, so as an LLC on the nomination, do I apply to the TPT?
So Delphina will talk about that. And this really goes back to the question about where services are being done, right? And what would constitute right here, right? So TPT is the sales tax, gross receipts tax here. And depending on where services are done, so Arizona is different than New Mexico. So Arizona taxes things different if it's a product or service and what location. So sales tax is going to be different based on where the transaction is happening, even if you are a entity of the Navajo Nation.
All right. And the next question is by C. Wadsworth. They're asking, is filing as a nonprofit different from what was discussed today? And I believe Valerie had a similar question earlier, further up the chat.
Yeah, so this is totally different. Nonprofits are very different. So this presentation was made for for-profit entities here, but good good question. We'll have to do a presentation on that because that's a whole different beast.
Yes, yeah, I believe that's one of the topics that Holly and I plan to tackle this year, all things nonprofits. So please keep a lookout for that for those of you who are operating and starting nonprofit organizations. All right, and the next question is by Terry. Self-employment tax equals Medicare, Social Security, and revenue minus deductions, correct?
So self-employment tax is taxed on the starting point is the net income, right? Depending on what entity you are. So we start off with a net income, but depending on how you keep other expenses, such as like your mileage or your home office, and whether or not they're being incorporated in your income statement, right, will determine whether or not this is the net income, the true net income, right? You might also have things like depreciation that isn't shown here. So essentially, you would take your net income and self-employment tax is charged on that. But then you also get charged for you get taxed for self-employment tax, but then also they give you a credit back for it. So confusing.
All right, and then thank you. Does that answer your question? Josh had a similar question right after that. He's asking what makes up self-employment tax?
So self-employment tax is like your Social Security and Medicare tax because you are not being taxed from your employer. So on your employer, you are getting Social Security and Medicare tax equals 15.3%. Half of that cost when you are a W-2 employee is covered by your employer, half is covered by you. So when you come into a situation where you're your own boss in the sole proprietorship, this comes down and you would get charged self-employment tax on that, but then you also reap a benefit from it. They give you a deduction for it. So they charge it and then they kind of say, well, here's some of it back. So if you're paying yourself with a W-2, you're already having that expense paid. So in an S Corp, the benefit is when this guy comes down, because you've already been taxed, you've already been paying self-employment tax here in your wages, right? Your W-2. So we are an S Corp. I am an S Corp. So every time I pay myself, the business pays half of my self-employment tax, Social Security, Medicare, and then I pay the other half. So it's a reduction in my check. So at the end of the year, if we have a profit, that's not taxed again at that self-employment. So if you're not paying, say that, I see this a lot too. So people come to a situation and they're like, oh my gosh, I'm going to have to owe all this taxes. I made a profit, and they're a sole proprietorship, and all of a sudden it's like a rush to spend all this money, right? So it might come to a situation where now they show that they have a loss. You're not getting, if you have a loss, you're not paying self-employment tax, but also realize that the self-employment tax is part of your retirement plan when you're older. So if you're not saving outside of, so if you're not doing like a 401k or anything like that, this is how you're paying into your retirement when you get of retirement age. So if you constantly over the course of years show that you don't have a profit and you're not paying self-employment, you're not paying Social Security, Medicare, then your retirement benefits, when it comes to retirement age, you just lost out on that. So it can really hurt people in the long run if you're not saving outside of that. And I believe Josh would be a really good person to talk about 401ks and different things like that.
I do have one, two more questions, and then we'll let everyone go. I don't want to, we are a little over time, but I know we've got a little bit of a late start. So Sasha's asking, what if you were paying yourself with a W-2?
I think I addressed that one there.
Okay. And then Josh has, what are the long-term implications for not paying into self-employment? Oh, you got that too.
Yeah.
All right.
Right.
Sounds
So great questions. Each situation is different, but this is why coming to someone to help navigate you is so important. So if any of this was confusing, or you just, your reaction is to kind of shut down and, not pay attention, or those are all normal responses, but please reach out to one of us and talk with us. We're able to help you here. So I'm looking forward to all the wonderful things that you guys will do.
Awesome. Thank you so much, Amber. I really, really appreciate every time you're able to come and do a presentation for us. And thank you everyone for being here with us for our first Kickstart. I know it was a little bit of a rush start, but I'm going to turn the time over to Holly for the last second and then last announcements we have.
Yes, thanks so much. So tomorrow it's going to be, another session that's covering essentially taxation and further explanations of types of taxation that Amber was talking about today. And that's going to be led by Delphina Begay. She's going to be talking a lot about the compliance and understanding the different taxes, such as sales tax and income tax of just the Arizona and a bit of the New Mexico gross receipts tax. And then as well as too for the income tax of the Navajo Nation. And then she'll also be talking to you guys to get you guys more informed and ready for the deadlines that are coming up for each of your tax compliance on the Navajo Nation, a little bit in the New Mexico side, and as well as on Arizona. And so we'll talk a little bit too tomorrow about quarterly estimate payments and how does your bookkeeping from one day forecast your taxation the following year, and how to stay on top of it, as well as too, we'll talk about the difference a little bit of the W-2s versus 1099s and what those differences are. And we'll talk a little bit about the beneficial owner information. That's a new tax item for this year. And so please join us tomorrow, again, either via Zoom or here at our Tuba City eShip Hub. If you join us in person, we have lunch. And we'll love to essentially continue the conversation as well too with Delphina Begay, who's actually going to be coming into our eShip Hub in person to deliver her content. So super excited for that. And then as well as our third day, in which she'll take all of the elements that we learned today and as well as tomorrow, and we'll apply into some real situational and hypotheticals, so you guys are better essentially understanding of what to expect as you guys are approaching your own tax seasons. So we'll talk a lot about essentially like qualified business expenses and what that actually looks like in a realistic sense for native or rural businesses. So thanks so much, guys.
All right, and doesn't look like there's any other comments or questions. So I'm going to end the session for today. We hope to see you tomorrow. And if you are available this evening, we do have our 4 p.m. Zoom group coaching session. So feel free to log on. It'll be the same link for today that we're using for this session. All right, we'll see you guys later.